This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril in Singapore. The top stories this hour. More massive deals fueling the AI trade. Amazon signing a $38 billion agreement to supply OpenAI with computing power using Nvidia processors. And Microsoft to spend almost $10 billion buying AI capacity from Australia's IREN. The Fed in focus too, with officials divided over the outlook for rates as U.S. factory activity shrinks for an 8th month. Also ahead, Starbucks selling a majority stake in its China unit to private equity firm Capital, and leading global bankers gathering in Hong Kong for a key summit. We're speaking exclusively with Goldman Sachs CEO David Solomon.
Take a look at how we're setting up in the Asian session. We are looking at Nikkei futures under pressure, 0.2%. Japan coming back from holidays. What we're watching is the Japanese yen at that 154 level against the U.S. dollar. Remember, we continue to see the downside pressure at an 8-month low right now, and we have seen officials continuing to intervene in the currency markets in order to prop the Japanese yen higher. We also have breaking news out of South Korea because we are now getting the latest CPI numbers, which was coming in above economists' expectations, gains of 0.3% month on month. Also, the year-on-year number gains of more than 2% above the Bank of Korea's 2% target. We do have a weaker won for the South Korean economy, not to mention rising housing costs that is adding to that pressure on prices. And you can see the ASX 200 pressure of 0.2% is the RBA rate decision. A hold is expected there, Avril.
Yeah, let's also take a look at how Wall Street fared overnight. On top of the RBA decision, we're of course passing whatever Fed speak we got overnight, but worth noting how the S&P 500 looked pretty flat at the start of what's typically the best month of the year for stocks. We did see, though, the Mag 7 gauge surging up 1.5%. It's really this AI play, Amazon deal as well, fueling the AI bets. We had the likes, of course, of ChatGPT. It's going to be paying AWS to access these Nvidia GPUs as part of a 7-year deal. Now, on top of that, we're watching treasuries because, as I said, it was about the Fed speak. You had the likes of Austin Goolsbee sounding a bit more worried about inflation than the jobs market. And then you also had a report on the other side of things showing the continued slump in manufacturing in the U.S., but also kind of tying it all together with the tech story, these bond sales, right? Jumbo corporate bond sales, including from the likes of Alphabet, $18 billion it's selling of bonds in the U.S., following on from Meta's roughly $30 billion offering last week. Now, let's get more details on Amazon's $38 billion deal with OpenAI. Our tech correspondent, Annabelle Jollers, joins us now. So, Belle, what do we know about the deal?
Yeah, well, what we know about the deal is that certainly it's sort of just another sign that we're seeing that OpenAI is transforming into an AI sort of mega center or powerhouse in the industry. But the details of what we've learned and what was being shared by the companies on Monday in a statement is that essentially Amazon's cloud units, this is AWS, of course, has inked a deal to essentially gain a slice or to provide access to OpenAI and try and fulfill some of OpenAI's seemingly bottomless demand for compute power. So what's going to actually happen here is that OpenAI, the maker, of course, of ChatGPT, is going to be paying AWS a very hefty sum of money to then be able to access hundreds of thousands of GPUs. And this is a deal, as you said, it's going to be a multi-year agreement. It's going to be going out over 7 years. It is worth nearly $40 billion. For Amazon, I mean, it's very good news for Amazon because it is a company that's really sort of struggled to compete in this AI age, but it is an endorsement of their ability to be able to build and run enormous amounts of data. You can see here as well, this is the reaction we got from our Bloomberg intelligence team, and they say this is really aimed at inference capacity. So training is sort of the training of the models. Inference is more focused on the deployment. And so even though this agreement at $38 billion, they're saying is about 6 to 8 times smaller than other compute deals that OpenAI has signed with Microsoft and Oracle, they do think that Oracle is seeking leverage in this and also to diversify some of its cloud infrastructure as well to try and boost its advantage against other frontier models like Anthropic, but also Google's Gemini.
It's incredible the number of deals that we're seeing in the AI space these days. Microsoft also signing an accord with a Sydney-based data center firm.
Yeah, that's right. And to your point, I mean, I think that's why we always have these concerns. Are we in the middle of this AI bubble? But this has been another announcement overnight. Of course, not quite as big in terms of size. This one coming in at $9.7 billion. But it is a deal that Microsoft has signed with a Sydney or Australian headquartered business. This is IREN. They're a major data center firm in the country. And what's going to happen here is that it's going to be essentially, yes, a deal that they're going to be buying compute capacity from IREN. And it's an agreement that's going to go over 5 years. Instead, it's going to give Microsoft access to Nvidia systems in Texas, and it does include as well a 20% prepayment for the business, which I guess also one of the reasons you saw such a big jump, because IREN is listed in the US, so you saw that pop already overnight. IREN, they're going to be using this deal as well to try and buy more advanced chips, also more equipment. They're going to Dell for this technology, and they're going to be spending nearly $6 billion with the business as well. But they are thinking that this sort of accord or this agreement between Microsoft and IREN is going to be something that generates nearly $2 billion each year for the business in revenue.
Annabelle Jewelers there with the latest on all of those AI deals that we're seeing right now, and that frenzy continues over the artificial intelligence trade. Let's bring in Bloomberg MLive strategist Mark Cranfield. Mark, yes, the AI frenzy, exuberance continues, but at the same time, if you look at the S&P 500, 300 firms or more actually fell in the overnight session. What does this tell you about the breadth of the rally?
There's not much breadth. That's what it tells you. The concentration is not necessarily a bad thing, providing that the companies where that concentration is happening are very profitable, whether the outlook is very good for the months ahead, and whether investors really believe that the story is going to continue and take the rest of the market eventually in the same direction. So that's really what you're having with this AI concentration for now. That theme is very strong, as Belle has just been saying. It keeps on reinforcing itself, and it's spreading to becoming a cross-asset story as well. And it doesn't look as though people are willing to give up on it yet. And when you see the reinforcement with big deals almost on a daily basis going on here, and we've seen it transfer to Asia as well. Jensen Huang came through the region, put his stardust all over the places, particularly in South Korea. So it's becoming a bit of a global theme as well. As long as the numbers, as long as people see there's profitability, as long as they don't see it suddenly going to hit the barriers, it will continue to fuel asset markets. People are even talking about treasury yields being supported because these deals to fund the expansion in AI are so big. You've got people like Alphabet, Meta have already tapped the bond market as well, and they're beginning to say that this could put a floor under medium to long-term treasury yields because of the demand to borrow money. So it really is developing into a multi-asset theme, and it isn't running out just yet. At some point, people will say it's gone too far, but for the time being, investors seem pretty comfortable with it.
To your point about the Nvidia chief sprinkling the AI magic across this part of the world as well, what are you expecting from Asia today, particularly Japan, that comes back from a long weekend?
Yeah, it's a big day for Japan because not only do they return after a gap, the yen's even a little bit weaker than when they went on holiday. That will help to support the market to some extent. And we've got Nintendo. Nintendo is one of the biggest companies in Japan. They will report after the markets close later today, but the expectations will be very high. We saw their recent Switch 2 program. Demand is extraordinary for their products. They're having to ask their suppliers to ramp up the number of units they make. That's going to be very positive. They still need to give a positive outlook. That is what investors really care about these days. It's not just the numbers that are released on the day. It's about where do you see things going over the next few quarters, similar to the AI story as well. Providing Nintendo tells people that their order books for 2026 are very good, things will keep going. But certainly you would expect, and the correlation between the direction of dollar yen and Japanese stocks has actually tightened since the beginning of October. So with the yen being relatively weak, it will probably boost Japanese stocks as well.
Is there too much froth out there, too much optimism? Yardeni of Yardeni Research now saying that too many bulls is actually a contrarian sign.
Yeah, people have been saying that for a little while, and Alan Greenspan famously said, "You only know there's been a bubble after it pops," which isn't particularly helpful. The issue is really, when do you want to predict that the top has been reached and that it's all over, the best days are behind you. A lot of people talk about comparisons with the internet bubble back in 99, 2000, that kind of period. Well, it was for about a year that people thought markets were overvalued, and eventually it snapped. If you'd had stayed out of the market for that year when people first started saying that the market was too high, you would have missed out on some very, very big returns. Most fund managers are still looking at year end. They want to be able to produce great results. It's been a tremendous year for equity markets around the world. They probably want to stay in as long as possible to book those tremendous year-end results. If you come out now, you could be missing another 20% upside on the market. That's the dilemma for fund managers. They may think valuations are very high. They may think the market is getting frothy. But if you exit now and your competitors still stay in for the rest of the year and you don't, you could look pretty bad. The AI story looks as though it's going to run into 2026. So if that's the case, if you believe that, you're not going to be exiting the market just yet.
What is remarkable to me, Mark, is how, in spite of the Fed rethink or recalibration from last week, we're still seeing this AI rally. We're hearing more Fed speak from the likes of Mary Daly. Take a listen.
Keep an open mind. This really means assessing the incoming information, keep an open mind, and make the decision that balances those risks and ensures that the economy can go on and achieve the soft landing.
Okay, so she's saying keep an open mind. Then on the other side of things, we have Goolsbee saying maybe he's a bit more worried about inflation than the jobs market. Where are we on the Fed?
They're in a very difficult spot. They're missing so much data. They, as Jerome Powell liked to say, they're flying blind. All they've had is a CPI report in the past few weeks. They don't have much jobs data apart from some of the private data they can pick up. The fact that the government shutdown, is getting close to being the longest on record, and we're in the month of Thanksgiving as well. This is a very big deal for the American economy. If they don't solve the shutdown before the Thanksgiving and the Black Friday period, it will have a detrimental effect on the US economy. I don't think many people would argue with that. That will affect the job numbers as well. So the Fed is in a situation where they may think that there are inflation risks to the upside. The data isn't confirming that yet, but they will be very worried about the jobs market, particularly if the shutdown goes through to the Thanksgiving period as well. And then the pressure will come on them to lower interest rates again. So for now, traders think there's about a 70% chance they will lower rates in December. That's unlikely to go down given the fact that the shutdown is running and there doesn't appear to be an immediate solution to it. So that's all dampening demand in the economy. The Fed has to play, there's so many balls in the air for them, but they would love to have more data. They would love to have more clarity on what is really going on in the economy. And at the moment, they don't have it.
Mark, does the RBA have a little bit more clarity? We saw consumer prices surging more than expected. What are we expecting from their policy decision today?
They could be on for a long hold, the RBA. Also, the housing market is picking up in Australia as well. We've seen data in the past few days suggesting that some parts of the Australian property market are the hottest for the past 2 years. That will worry the RBA because they know that there typically are inflationary knock-on effects. Once the housing market starts to boom, you get people spending more money on furnishings and things like that, and it all spreads through the economy. So that will be a concern to them. Not just those quarterly numbers, which were stronger than expected as well. So that gives them plenty of reason to be cautious. That's the kind of language they've been using recently as well. Likely to hold today, likely to hold for some time. There isn't going to be much reason for the RBA to look at lowering interest rates. They'll probably say to themselves, we want to go well into 2026 before we have to make a big decision. That will suit them nicely. It'll be positive for the Australian dollar. If we do get more hot inflation data, people will even be thinking the next move from the RBA could be to raise interest rates, not lower interest rates. But that's probably something way off into 2026.
Okay, we'll watch the messaging from the RBA later today. Mark, thank you. Always fantastic, insightful. Great to have your analysis. Bloomberg MLive strategist Mark Cranfield. Now, coming up on the Asia Trade, we're live at the Global Financial Leaders Investment Summit in Hong Kong. Joining us from the venue is the China Show co-anchor David Ingles. David, give us a preview. Who's going to be making headlines this year?
Well, certainly not your interviews as well. So you gotta send a thank you card to Yvonne and myself because we're taking over parts of your show. Thank you so much, by the way, for giving us some of the real estate. We're kicking things off this hour with really 3 big interviews just to get things started. We're going to get Matic from about 7:30 morning. About 20 minutes from now, Schroders CEO Richard Oldfield will be joining us, followed by our hosts. Eddie Yu out of the HKMA will be speaking with us here on sets. And shortly after that, David Solomon, of course, out of Goldman Sachs will be joining us here on set as well. It's a fantastic time to be speaking with everybody today. I'm going to give you guys 2 numbers, right? North of 50%, that's the rally in the equity market here in Hong Kong. 50 billion, north of 50 billion is the amount of money raised here in equity markets. So the biggest deal makers in the world are gathered here in really what is not, there's no other better place in Hong Kong to having these conversations in the world's #1 hotel, right? The Rosewood. So we're gathered here today. And Shery, I've heard you talked about frothy several times already. The only thing frothy today is the coffee here at the Rosewood. What can you expect? The world's #1 property. Anyway, we'll have a lot of headlines coming through here out of the HKMA Financial Leaders Summits, trekking through shifting terrain. Good morning. This is Bloomberg.
Wheat futures in Chicago jumped with China seeking its first U.S. shipments of the grain in more than a year. It follows orders for U.S. soybeans as part of a trade truce between the two nations. Let's bring in our China correspondent, Min Lo. And Min, soybean purchases were sort of the low-hanging fruit of this trade deal, but at least we're seeing Beijing following through with its commitment.
Yes, and actually there is a lot of market speculation happening right now because guess what? We have the government shutdown, so there is no real reliable data on trade flows at the moment. But sources are saying that one grain importer has been starting to inquire on potential wheat shipments in the coming months, and that's why we are seeing Chicago wheat futures rising to the highest in about 3 months. A big question is how much exactly is China going to buy, especially if you consider that year to date so far, China's total wheat imports have fallen to less than a third of what it was a year ago on the back of sluggish demand domestically and ample supply as well. So it actually doesn't make sense for China to be absorbing a lot of that imports from the U.S. But for sure, it's a good sign so far that just days after that trade talk had concluded, we are seeing very quick follow through from China on the to buy these potential shipments of wheat. And it's also coming as the White House had announced that China will be removing all of the tariffs on U.S. agricultural goods as well.
The other thing that's been in the spotlight is Nvidia and its Blackwell chips and whether it's going to get to sell to China. Do we have more insights into what the U.S. administration is thinking? Might a further discussion on chips still be on the table?
Yes, we are getting more insights on the thinking behind the U.S. administration. This is coming from Wall Street Journal's reporting, and it seems like President Trump was actually pretty open to discuss the sale of these Blackwell chips to China. But after the Asia trip, he was advised by some of his closest advisors, according to Wall Street Journal, especially the likes of Marco Rubio, Jamieson Greer, Howard Lutnick as well. So a near unified opposition from his closest advisors to sell those chips to China, because bear in mind, these are the most powerful line of chips that Nvidia has. It's about 3 times more powerful than the H100 chips when it comes to AI training, and about 15 times more powerful when it comes to inference power. And Nvidia, for example, has been lobbying the government very hard, saying that this is a wrong move. It could cede the market entirely to China. There's also another argument that it's important to get Chinese tech companies hooked on U.S. hardware to get them to be reliant on U.S. technology. But we hearing now Wall Street Journal reporting that that Nvidia is still waiting for approval from the White House for the sale of a scaled-back version of its Blackwell chips, perhaps something that is 30 to 50% less powerful than what it is now. So potentially, yes, there could be further talks on the table that could look at the sale of the scaled-back version of the chips, and perhaps that might might entice China to put aside some of its security concerns about the backdoor of using US chips if they can get access to more advanced chips than the H20, which China so far has not been buying.
Min Min, thank you so much. Bloomberg China correspondent Min Min Lo for us there. In other news, the U.S. Commerce Department will provide $50 million in CHIPS Act funding to Vulcan Elements, a domestic rare earth magnet producer. The firm is also receiving a $620 million Pentagon loan and $550 million in private capital to build a U.S. magnet facility. Its partner, ReElement, will also get Pentagon support, and the move aims to boost U.S. magnet production amid trade tensions with China. We have more ahead on the Asia trade. This is Bloomberg. The top corporate stories we're following: Starbucks is selling a majority stake in its China unit to private equity firm Boryu Capital for $4 billion. Boryu will take up to 60% of Starbucks' China retail operations through a joint venture. Starbucks will hold the remaining 40% and says it expects the total value of its China business to exceed $13 billion. Denny's shares jumped in late trading after it announced it will be acquired by a consortium led by PE firm Triartisan. The deal will value the company at $620 million, with shareholders receiving $6.25 per share, a premium of more than 50% to the closing price. The company cancelled its third quarter earnings call following the announcement. Denny's owns and operates about 550 restaurants around the world. And Bloomberg has learned that Alphabet is selling more than $17 billion worth of bonds in the U.S. as it invests aggressively in AI. The source says the bonds will be sold in 8 parts with maturities ranging from 3 to 50 years. Alphabet earlier issued nearly $8 billion worth of notes in Europe, marking the second largest bond sale this year in the region by a non-financial company. Shery?
Avril, take a look at how crypto assets are trading at the moment. We're seeing downside pressure with Bitcoin trading below $107,000 and altcoins also struggling. And this really coming as a hangover phase from October's liquidation shock. Remember, in the month of October, Bitcoin lost about 5%, seeing the largest crypto liquidation in history after Trump announced that 100% tariff on Chinese imports and threatened export controls on critical software. So you're seeing Ether, Solana, and Binance all losing about 0.5% right there. Solana under pressure and Bitcoin down 0.4%. Coming up, we take you live to the Global Financial Leaders Investment Summit in Hong Kong. Schroders CEO Richard Oldfield joins us next. And stay tuned for conversations with HKMA Chief Eddie Yu and Goldman CEO David Solomon. This is Bloomberg.
Let's take a look at Asia markets. We have Australia's benchmark sitting softer ahead of the RBA decision today. Nikkei futures pointing to upside gains, perhaps tracking Wall Street as Japan comes back from a long weekend. We are going to be watching those AI-related stocks, of course, following on from Amazon really fueling that AI frenzy overnight with its deal with ChatGPT. And we also have the Hong Kong Monetary Authority holding its 4th annual Global Financial Leaders Investment Summit this week. Let's cross over to Hong Kong, where the China Show anchors David Ingles and Yvonne Mann are standing by.
Yeah, good morning, guys. Thank you for having us today. We're starting the show somewhat early today. Certainly, we're going to hear a lot of conversations coming through here from the Hong Kong Financial Leaders Summit. In fact, we're going to kick things off right now with the Schroders Group Chief Executive here on set with us, Richard Oldfield. Oldfield is here with us on set. I was looking at the wrong camera. Okay, this is go.
We've been redirected.
Yeah. Early cobwebs. We've shaken that off now. Okay, we need our coffee too. Good morning, Richard. Thank you so much. And apologies for seeing that.
True professional.
Okay, there we go. Almost didn't notice. You were at the dinner. There was a welcome dinner last night.
There was, yeah.
What was the mood like in the room?
Well, really upbeat, actually. I made the comment that I spent the weekend here in Hong Kong, and there's a real vibe that's come back to the city. Each time, I've been here 4 times this year, so each time there seems to be more and more energy building back in Hong Kong. It's great to see clients and old friends in the room last night. And importantly, I heard about the 4 Trails Challenge, the 298 endurance run.
Okay, well, are you about to
I'm taking that as
embark on that journey?
I'm sticking to asset management, not 298 kilometers.
That's harder.
Tell us a bit more about it seems like capital markets are very strong right now. How does that make you feel about overall the greater China market right now? I mean, the deals seem to be a flurry of them of late.
Well, actually, this is a great part of the world for wealth creation. So we've been in the region for more than 150 years. We've been here in Hong Kong with a physical office for more than 50 years, on the mainland for 30 years. Actually, Hong Kong is one of the few markets where you can see a really strong deal pipeline from an IPO perspective. Really excites me about this part of the world is the growth in wealth, right? So it's at least 2% higher than any other part of the world. We've got a 47% explosion in Chinese ultra-high net worth individuals, forecast to 28. So, I think even as we look at what's quite a difficult and choppy set of markets globally, we're really positive about Asia.
Yeah. Do you have a sense that you have enough resources and manpower complement to, I guess, take advantage of the trend you're mentioning, right? By 2028, it's quite a substantial amount of money that's up for grabs.
Well, what's been really important to Schroders is we build our business by having investors here on the ground in Asia. So we don't just have salespeople, but we have here in Hong Kong, we have a big Asian equities team. We have on the presence investors in China, in Taiwan, in Australia, in Indonesia. And that gives us a really local flavor to what's actually happening. And it's important for us to help our clients that we get the real beat of what's happening in the individual markets.
A local flavor is interesting because you saw a bit of outflows in the latest quarter when it came to Asia real estate. What's the latest plan to really kind of streamline your strategies right now?
So what we outlined, Yvonne, back in March was a process to get Schroders back to profitable growth, and importantly, one where we deliver for our clients and we're relevant on an ongoing basis. So what we said we would do is streamline our business, and that would enable us to take cost out. Now, taking cost out is important because it means we can deliver our products to our clients at the price point that they really need, as well as actually some pretty aggressive revenue growth targets that we talked about. So in terms of Asian real estate, what we saw is, you'll see in the market, commercial real estate has been depressed. Really positive sign here in Hong Kong in particular is we can see the residential property market certainly lifting. But in terms of commercial real estate, we continue to work through some of the challenges of the marketplace and streamline the business.
I mean, you do have some properties here where, let's just call it, the time you went into the transaction is no longer the value of the properties right now. Properties under your property management. Just get us up to date, Let's avoid speculation. Let's hear it directly from you.
Well, look, I think we and the whole industry has the challenges of a commercial real estate market that is significantly down from its peak. Okay. We have 3 properties, you're right, that relate to an investment business that we acquired, and those investments go all the way back to the early part of last decade. Of the 3 properties, 1 is being worked out and 2 are actually being dealt with by the bankers at the moment, but we've kept our investors fully informed and we're on top of it.
Are they for sale? When you say you're working them out, like 1 is actually for sale, and when do you plan to sell that, if I could ask?
So 1 has actually been fully let, and the lending associated with those properties has been renegotiated, and the other 2 are being worked through with the banks.
Are you willing then to commit more capital to this city then, if there are concerns whether you get the value back or not? I mean, I'm just wondering, you mentioned about residential property. What are you seeing there in terms of opportunities?
Well, residential property isn't our main investment thesis here in Hong Kong. What we're really focused on growing is helping people pivot into global equities. We can see a real shift in the market into global investing. We can see the need to bring more private markets activity here into Asia. So So we have a team here in Hong Kong, and we've invested pretty heavily in that team to grow renewable infrastructure. So we have a business focused on the energy transition. It's really helping clients invest in the mainland in green supply chains. It's actually helping mainland clients invest in opportunities for mainland companies overseas. So we're super excited about the growth area, what we see in that part of the business. And of course, as I said, what we're really making sure we're doing is delivering the products that we think the wealth channel is going to need as we go forward. We work pretty extensively with partners here in Hong Kong and across the region to make sure that we can help them deliver what's needed for their clients.
Two things have constantly and consistently come up as far as investing in equities, or public markets, generally speaking. Concentration risk and AI, and the other extreme is really just completely outside of public equity, is private markets. So where is your head on those two things?
So we remain pretty positive on US equities and China equities, by the way. And there are two areas, of course, where we do see concentration. And that's why, importantly...
Too much concentration?
Well, that's why, importantly, we are passionate advocates for active management. That's all that we do.
Okay.
And that means we can balance risk and return. And so when we see concentration that you're talking about in the marketplace, we can make decisions about how much of that concentration we participate in and where else we might choose to invest our money. So passionate advocates for active management, really important point for investors in terms of thinking about how they diversify their portfolios.
Yeah, interesting. You mentioned before that this whole active and passive debate is dead. How do you still deliver in this market when there are these players like the BlackRocks and the Vanguards of the world that have these very low margin passive products out there and are only kind of squeezing your fees lower now?
Well, I think the thing we forget, everyone talks about the rise of passive as being a new thing. I mean, we've been dealing with it for 20 years, candidly. So it's quite a long trajectory. And it's an important passage, an important part for people to build efficient portfolios. But it comes on back to my point about let's make sure we think about return and risk trade-offs in the appropriate way. So there was this nonsense of people will have barbells of just passive and private markets.
Right.
Well, there's got to be a place in the middle where people think about that diversification. So it's kind of interesting. One of our most successful strategies in the last few months has been actively managed US large cap. Now, a year ago, I just said that was a pure passive play.
Yeah.
But people are taking that concentration risk you talked about, David,
right.
and say...
Why is that an accurate strategy, if I could just ask you that? If it's a pure large cap, US large, that sounds like a passive.
Because if you're worried, because of course what's happening is if you're a passive player in the S&P, the vast majority of that investment, because of the market weighting, is flowing into the top 10 stocks. So actually, if you're really looking for value and thinking, well, maybe I'm a little bit concerned about how those valuations are stretched, you want to have an investment strategy that's a little bit more spread than a just S&P 500 passive product.
Right.
So that's the great benefit of active. I think the other great benefit of active that we often don't talk about is it's about active ownership. So we get to choose who we invest in. We get to hold management to account. We get to challenge strategies and actually think about how organizations are developing in the marketplace, really looking for how they're delivering opportunities. So yeah, I always say the great benefit of our investors, they get to choose every day whether they want to invest in a stock or not. They get to engage with management and hold them to account. And that is one of the few things that, of course, passive people can't do. They don't actively engage because they've got to replicate the index.
There's also this trend of de-dollarization. What are you seeing in terms of some of your institutional clients now on whether there is a need still to diversify away from the dollar?
Well, it's a great question. Probably one of the questions I'm asked most as you go around the world. I think we're a long way away from seeing the US threatened as pretty much the reserve currency for the world. There are some things acting in its favor, by the way. The growth in stable coins is a great example of where dollarization is being reinforced by other trends. But it is also great to see the internationalization of the renminbi. I mean, that is a really important point to offer choice to clients. We're seeing more and more clients in trading flows actually having to settle in Asia, but not just with China, with the renminbi. So I actually think we're going to see over the next few years a change in the landscape.
Richard, thank you so much for taking the time. Enjoy your conference. And this is your 4th time here this year, so let us know the next time you're in town.
Yeah.
Right? Great. We have a nicer studio than the Rosewood. Richard, fantastic. Thank you so much, Richard Oldfield, Group Chief Executive at Schroders. Shery.
Yeah, David Inglis and Yvonne Mann there joining us from Hong Kong. And of course, you guys will have plenty of more coverage coming from the Global Financial Leaders Investment Summit. We do have HKMA Chief Executive Eddie Yu, who will be joining us shortly before we speak exclusively with Goldman Sachs CEO David Solomon. But here are some of the other corporate stories that we're following right now. Millennium Management CEO Izzy Englander has sold a roughly 15% stake in his hedge fund to a group of investors. Sources telling Bloomberg that the roughly $2 billion sale values the company at about $14 billion. The deal diversifies ownership among several large institutions and top executives. Point72 Asset Management is creating a new equities unit, joining other multi-strategy hedge funds that operate several stock-picking businesses. A note to employees seen by Bloomberg says a new unit called Velis Asset Management will be organized starting January. Billionaire founder Steve Cohen says the firm has meaningfully increased both team count and capital allocation for the new strategy. Palantir has raised its annual revenue outlook to $4.4 billion. The firm's third quarter sales outpaced analyst estimates, with the firm describing growth for its AI and data analytics products as otherworldly. Revenue increased 63% to just under $1.2 billion in the period ended in September. And Palantir expects current quarter sales to be about $1.33 billion. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how currencies are trading, and as the dollar continues to extend gains, we have seen the dollar, of course, perform pretty well for the month of October. We're talking about the second biggest gain this year. The premium paid to hedge against a rise in the greenback against a basket of peers over the next year, also at the highest since April. On the other side of the trade, we do have the offshore yuan at that 712 level. We continue to watch those PMI numbers, a little bit of pressure on the factory activity numbers. The euro holding steady, but what we'll be watching today is the Aussie, which has been one of the best performers in the past quarter. We do have the RBA rate decision today. Let's head back to the Global Financial Leaders Investment Summit in Hong Kong, where David and Yvonne are with the event's host and chief of the city's de facto central bank. David, Yvonne.
Yeah, they are also the hosts, of course, of this big event, which is in the fourth year running already. And certainly, let's bring in Eddie Yu, HKMA Chief Executive. Eddie, it's always great to have you here.
Good morning,
we were just talking to Schroders about the dinner you guys had last night. There's such a resurgence that we're feeling here in Hong Kong now. Does it feel different to you this year?
Yeah, if you remember, this is already the fourth investment summit. If you remember, our first summit was held 4 years ago. It was meant to be just a one-off COVID exit event. But we did realize that it's now turned into an annual tradition with more than 100 global CEOs coming to join us year after year. And we're glad about that. Last night was really fun. We put up a welcome dinner at the Palace Museum. We've organized technology. We've got a little robot boxer pulling punches and kicks and all that.
Yeah.
But at the feature presentation, we presented the hiking trails of Hong Kong.
Yeah.
We invited the director and the runners in the Four Trails documentary to come over. And we also show an edited 2-minute documentary to the audience. We really want them to see the other beautiful side of Hong Kong. But overall, last night, it was not just about the dinner, the feature presentation, but it was the vibe and the energy that you can feel when people are just going around, talking to each other and chatting, talking about all the opportunities that's available in Hong Kong, talking
there
about
seems to be a hiking theme, right? With the theme, trekking through shifting terrain.
Shifting terrain.
You can tell from from our theme. Because when you think about how we navigate through this changing world,
right.
It's a bit like hiking, where you really have to, demand your attention on what you're stepping on, evolving, changing all the time when you walk different terrains. So there's a bit of similarity there. But the main thing is we want to promote Hong Kong's hiking trails. It's really an attraction.
Well, I mean, to the point you were making, our earlier guest also just mentioned 4 trails, and this is the 4th edition, of course, right?
Oh, that's true.
The 4th edition, and I can't think. So we were at the last few ones as well. I can't think of anything. The conditions now are so much better. Equity markets are doing well. The economy grew 3%.
IPO markets are back.
The IPO markets are back. COVID's obviously something that we can put to history books, hopefully. And we're coming off this historic meeting between U.S. President Trump and Chinese President Xi Jinping.
Right.
Is there a risk still that you're thinking about, or is it really more opportunity now at this point in time?
If you're confronting different changes in the macro environment, in the markets, of course there will be risks here and there. But I think the important point for all of us is really just to address the risk, manage the risk. But at the same time, we are seeing loads of different opportunities. You talk about how our capital markets are really getting very vibrant. But it's not just the equities market. It's also the bond markets. If you look at the issuance of dim sum bond, one-time bond, green bonds, it's broken all the records. So I thought the market sentiment here is really vibrant. Plus the new opportunities regarding the various connect schemes, whether it's global investors using Hong Kong as a platform to get into Chinese assets because of diversification, or Chinese capital coming out to reach the world's global assets through Hong Kong, also because of diversification. We're seeing a lot of opportunities like that, not to mention the Hong Kong being the largest offshore R&B center. We are putting out a FinTech 2030 strategy with a lot of initiative on technology. Okay. So I think there are loads of things that people can explore in Hong Kong.
There's a lot to explore. There's also still some troubles in the real estate market, for sure, when we're talking about commercial real estate in particular. What do you think is sort of the state of play here right now? Do you think the worst is over?
Well, if you look at the residential property market, it's already stabilized. If you look at the first 9 months of this year, the residential property market, the index has gone up very slightly by 1%, but that means stabilization. So we're not worried at all. For the commercial real estate, again, it's continuing to confront some challenges. But the important point for us is that the banking sector, in terms of the risk, is totally manageable. One is that there's no concentration; it's spread across different banks, and it's also mainly some medium or small-sized developers. The large ones are okay. And also, if you look at the provisions that they've already made, it's very high. But after making those provisions, their capital remains very high at 21%. Their profitability remains very high. If you look at the first half of this year, profits of banks in Hong Kong went up by something like an average of 15%. So I think the risks are manageable, but it's something that we need to continue to monitor.
Right. And just to close the loop on that one, are banks capitalized enough? Do you see a need for more capital, capital raising given the amount of debt there?
The average capital adequacy ratio of banks in Hong Kong is more than 21%, against the international standard of just 8%. So to me, it's really already very strong buffer that can allow them to go through any shocks or any challenges in any sector.
You mentioned about fintech. Obviously, stablecoins has been the big thing for Hong Kong this year. We're also hearing when it comes to how Chinese authorities are looking at it, and reportedly, sources telling us that maybe that they are actually telling Chinese companies to stay off stablecoin. Have you heard of anything like this?
Let me just get to the stablecoin innovation. If you think about stablecoin, it's actually just one of the various blockchain-driven innovation. Of course, there's crypto, which is highly speculative. There's stablecoins, and the other side of the spectrum that we place even more emphasis as an enabler is actually tokenized assets, and we can get into more of that. For the stablecoin and crypto, in fact, our focus is on regulation. And that's why for stablecoins, which is a means of payment, we pull up a legislation which has become effective in August. And we are inviting applications from different entities who are interested. And whether it's Chinese or overseas or local, we welcome them all. And so far, we've got around 37 applications. Right. And we are now doing an assessment. We expect that the first licenses probably will come out in the beginning of next year. But again, what we are
How many are you looking to give out? I'm curious, out of the 37.
What we're telling everybody is that we want to go cautious in the beginning. So we will be handing out no more than a handful of licenses, maybe just 2 or 3. But we'll see how the assessment goes. We want to just go try out first. And our regulations may evolve as we start to see it operating, and then we can invite more to come.
Eddie, I understand that you have to go. I think you're doing a keynote inside, and of course you also have the Huli Feng speaking, and you have a panel. Thank you so much for having us. We didn't get to talk about the pig.
Yeah, but well, one word. It's not going to change.
I didn't ask anything. Eddie, thank you so much for having us. Eddie, you're the Chief Executive of the Hong Kong Monetary Authority. Avril, back to you.
Guys, great stuff. David Ingles and Yvonne Mann in Hong Kong. More coming up from the HKMA Global Financial Leaders Investment Summit. Goldman Sachs CEO David Solomon joins us exclusively in a few minutes. This is Bloomberg. Let's take a look at how Asia markets are faring. Of course, Australia is sinking a bit further into negative territory. This comes ahead of an RBA decision, and Nikkei futures also pointing to some downside despite the positive handover from Wall Street, really an AI-driven rally. Of course, a couple of stocks we're watching in the Japanese session following the long weekend. It includes the earnings-related names, Nintendo, and of course some of the automakers as well, including Honda and Toyota, that are set to report in the coming days. Markets open in Seoul and Tokyo next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. It's the RBA rate decision day, a hold expected today, but it's also, of course, about the AI trade frenzy that we saw in the overnight session, Avril, with the likes of a few multi-billion-dollar deals between Microsoft, OpenAI, and separately, of course, also we had Amazon as well.
Absolutely, Shery. And of course, passing the Fed speak, you have the likes of Austin Goolsbee sounding a little less dovish on one side, and then Lisa Cook, Mary Daly commentary coming in as well.
Yeah, take a look at how we're opening in the Asia session. Of course, the Nikkei is coming back from holidays already at record highs. Together with the South Korean Kospi as well at record highs, we have seen the Japanese yen under pressure on dollar strength recently, but still at around that 154 level against the U.S. dollar. In Korea, we also had consumer inflation coming in better than expected. But let's turn to Hong Kong, where the city's monetary authority is holding its 4th annual Global Financial Leaders Investment Summit. The China show anchors David Ingles and Yvonne Mann are standing by with our next guest.
Yeah, good morning, Shery. Yeah, thanks for having us on the show. Lots to talk about today. We talked about some really big numbers, right? 50%, north of 50% equity markets here. The amount of money that's been raised here in equity capital markets, not to even mention DCM, for example, has really been one where we haven't really seen these numbers in many, many years. So it's really quite a time to be talking about Hong Kong and its role really as a financial center, as a gateway into China. We just heard from Eddie Yu, who was just here, of course, our host out of HKMA, and they're about to underscore that point even further. when things begin in a couple of minutes. Well, anyway, to get us started, we have here on set exclusively with us David Solomon, Chairman and CEO of Goldman Sachs. Good morning. Very nice to see you.
Good morning. Good to see you. I'm glad to be here. It's good to be back in Hong Kong.
Very good conditions. We're in an equity bull market, Mag 7 and everything else. We've had this historic meeting last week between the two presidents, U.S. and China. What do you make of the state of play right now? Are we in a much better position than we were at the start of the year?
Well, it seems like the meeting was constructive. I'm watching the news the same way you're all watching the news. I think at the moment, a de-escalation is a good thing, but there's obviously a lot of work to do to really arrive at a real stable deal that can endure, over a period of time. I'm encouraged by the prospect of a potential visit from the U.S. president that was telegraphed in the fall. But for the moment, I did not think the escalation on either side was constructive. And so, I much prefer a de-escalation. And I think both sides really had a purpose in that meeting to talk constructively, to have a more de-escalated environment. And that allows now for constructive conversations as they move forward.
1 year truce, though, is there pros and cons to that? What does that do to business?
I couldn't hear what you said.
1 year truce, though, between the two. Is that a good or bad thing? I mean, what does it do in terms of business sentiment when there's a 12-month time frame now we're talking about?
It's better than an escalation at unreasonable levels, which is kind of where we were, over the most recent time. Trade negotiations are complicated, and there are a lot of issues on the table. They need thoughtful responses and responses that can be durable, that both sides embrace and get to the right place. Yes, there's some uncertainty because it's a 1 year, delay in all of this, but it's also a realistic period of time to try to get the right kind of deal done so both economies can move forward in a constructive way. And look, these are the two most important economies in the world. Right. I think it's very important that, we arrive in a better place where we can both participate constructively with each other in the global growth of the world.
I mean, speaking of, let me borrow your phrase, participate, there's been a resurgence in equity capital market raising here in Hong Kong. A lot of the Chinese companies, tech or otherwise, are raising capital for the future. I want to get your sense, as someone who sits in New York, you travel, of course, all around the world. Is there a lot of appetite now from U.S.-based investors to participate by giving that capital to Chinese companies right now in order to realize their ambitions?
Sure, there's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors, and this topic came up, and there were a couple of investors that basically said we all should be looking to China, and the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling. You've seen a big move in prices year over year. You've seen more foreign capital come in and start to participate. That's a fundamentally different question about the big capital allocators really fundamentally shifting their allocations up to be higher again. So foreign direct investment in China has come down. And I think one of the big questions is until we understand kind of the trade and the geopolitical landscape, it's harder to see significant shifts back to higher levels of foreign direct investment and more capital allocation. But for the moment, those flows are making for a better IPO market here and more opportunities here.
How do you look at that? I mean, the whole competition has kind of changed into the dynamics, right? You have so many of these Chinese banks now that are doing some of these deals with Chinese companies when it comes to going public. How does Goldman Sachs compete?
Well, Goldman Sachs competes just fine, thank you very much. When it comes to taking companies public on a global stage, Goldman Sachs is a leading position. We've had a leading position for 50 years, and there's always competition in the business, and we'll continue to compete. So we welcome competition, but we have a pretty active footprint out here, as you well know. We have a pretty active footprint around the world, and look, one of the big advantages, I just had breakfast this morning with a company here that it's actually a Chinese company, but the CEO, the founder was here. And why does he value Goldman Sachs? He values Goldman Sachs because we have access to people, information, capital markets all over the world, not just in a narrow portion of the world. And so it's a competitive business, it always will be, but I'm comfortable that we have the resources and the position to compete effectively.
Right. And, I've been reading up, of course, and I understand your history. You guys have been doing business in China a very long time. You guys took the big banks public back 20 plus years ago. So, I mean, you're headed there, my understanding. After here, you're going to China, of course, to speak with regulators, what have you. What's your long-term vision for the franchise in Greater China? What do you want? What do you want your franchise to become longer term?
I think you have to look at Goldman Sachs and just think strategically that as a global firm, that when you think about our businesses, what are our two big businesses? Global banking and markets, the investment banking and trading business, and asset and wealth management. And so if you think about how we think strategically about the firm, what advantages does the firm have? Yeah. Besides the fact that we have at-scale businesses, we're very good at those activities, we're leaders in those activities, and we have a right to compete and win, in those activities. Another big advantage for the firm is we're truly global. And in fact, we're more global and have a capacity to communicate and interact globally for our clients in a way that not many firms can. And so if you think about where GDP is in the world, where big economies are in the world, China is always going to fit that bill. And barring a much more significant shift in geopolitics and the relationship between the U.S. and China, there are definitely issues. There are definitely things that need to be sorted. But China's going to continue to be one of the most important economies in the world. The U.S. is going to continue to be the most important economy in the world. And we're linked. And so as a big global firm that does what we do, we have to be long-term committed to serving our clients that need access to advice, capital, and resources, in China and around the world. And of course, we've got to do that in whatever environment the regulatory structure or the geopolitics play up. But we're long-term committed. We've been long-term committed, and we'll remain long-term committed unless there was something that significantly changed that.
I'm glad you mentioned that because we've seen governments being, I guess, more involved in some of these business deals. I take a look at Intel, for example. I look at Nippon Steel, even CK Hutch, which Goldman Sachs was a sole advisor to. What's the advice now to clients now in terms of that intervention risk?
Well, you just mentioned three different deals, and they're completely different.
Right.
I mean, they're completely different. Governments are always going to opine and weigh in on different transactions. There are regulatory approvals in the United States. There's CFIUS. There are all sorts of issues where governments weigh in. That is a very different thing than a government taking an investment, in a specific company. Sure. Wouldn't surprise you, I'm not a big fan of that as a general practice. That doesn't mean there aren't exceptions, because I believe that the markets should allow capital formation and competition, around companies. And this administration is in one or two situations. They're taking actions like that. As I said, I'm not black and white and dogmatic. There can be exceptional circumstances. But I don't think as a general practice, having governments take stakes in companies is the direction of travel we want our free market system to go.
Right. You mentioned how would you describe the current environment for deals going into next year? Because I remember just sitting here this time last year, and we were going into 2025. There was a U.S. election. We weren't sure where the guardrails were going to be. Looking at next year, I was just speaking with Yvonne. I can't seem to think of a major risk apart from, I guess, frothy valuation. We can talk about that later. But what's your sense of the environment right now, and what risks we have to consider? What's not obvious?
Well, in the U.S., and the U.S. is a huge part of the global M&A market, either for target or acquirer.
Right.
I would say it's extremely constructive, and we see it, in our advisory business. You can take a look at our, M&A revenues last quarter, which are a reflection of deals closing. But if you also go through our earnings call, we made a comment about the level of our M&A backlog,
yes.
The very high level of our M&A backlog. Yeah. And that's just an indication of the fact that there's a lot of activity inside the firm. I say this is really rooted from the fact that we went through a period for 4 years during the Biden administration where if you wanted to do something strategically, if you wanted to do something significant from an M&A perspective, whatever the question was, the answer was no. We're now in an environment where whatever the question is, the answer is maybe. And I think CEOs are unleashed in believing that they have a chance of doing strategic things to advance their position, to advance their scale, to advance, how they sit competitively. And so we see a tremendous backlog of significant consolidating situations, what I'll call large cap M&A. Large cap M&A in the United States is up very, very meaningfully. Deals over $10 billion, very, very meaningfully year over year. And so I think we're in a pretty constructive environment. And my expectation is 26 and 27 will be quite constructive in terms of large cap M&A, particularly in the United States.
Obviously, we've been talking about AI. That's a big thing in terms of how does it work for Goldman Sachs in terms of operational efficiencies? How does the onslaught of AI really going to impact how you hire or even just headcount in this part of the world now, David?
Well, it's interesting to me that you go right to headcount, and I actually think that that's a different lens than the lens that we would look at. And I don't know if you saw, but when we reported earnings 2 weeks ago, we put out a memo that we called Goldman Sachs 3.0, where we highlighted the approach that we were taking to integrating AI, and we talked about a handful of things that were goals, including operating efficiency, automation, better sales management. And then we identified 6 processes that we were going to look at from a very fresh perspective to see if we could automate them and build better efficiency so that we would have more capacity to invest in areas in the business where we see growth opportunities. And so, I think for a firm like Goldman Sachs, there are 2 avenues here. One, we have very smart people.
Right.
And we can put these tools in their hands, and that makes them more productive. And by the way, that's no different than 40 years ago when I was starting and somebody gave me a desktop computer and Lotus 123 software, and I had the ability to do a spreadsheet in a fraction of the time that it took me before that tool was put into my hand. That just continues. That's been going on for 40 years. It doesn't mean we have less smart people inside Goldman Sachs. If you look at Goldman Sachs productivity per person, it's much higher today than it was 25 years ago. And my guess is 25 years from now, it will be much higher than it is today. But our goal is to figure out ways that we can invest in growth, because we see lots of growth in our franchise. By using AI technology to reimagine processes, we can create operating efficiencies, and it gives us more of a scaled opportunity to reinvest in growth in the business. And look, of course, over the way, there are going to be shifts in jobs and job functions, as there always have been. I think one of the things you've got to wrestle with today is the pace of this is quicker. And so since the pace is quicker, there's a chance that it might be a little bit more disruptive, in the short term. But at the end of the day, technology changes jobs, it changes the way people work. This has been going on for a long, long time. It is continuing. I don't think it's different this time.
David, thank you so much for the time. I know you have to go and enjoy the conference. We'll see you again next time you're in town.
I appreciate it. Thank you very much for having me.
Appreciate this. David Solomon there, guys, Chairman and CEO of Goldman Sachs. Avril, back to you in the studios.
Thanks, guys. Co-anchors of The China Show, David Ingles and Yvonne Mann in Hong Kong. And we are seeing the tech rally in the U.S. not quite translating in the Asia session. Markets looking a little soft in this part of the world. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how equities are trading early in the Asia session. We are seeing broad downside pressure with the Nikkei falling from record highs. It's come back from holidays and the Japanese yen has topped 150 per dollar, but we're seeing tech being one of the few sectors that's gaining ground right now. Of course, we had that AI optimism and exuberance in the overnight session with a few deals in place, but let's get a few more details when it comes to Amazon's $38 billion deal with OpenAI. Our tech correspondent Annabelle Drewlers joins us now. What do we know about this?
Yeah, well, this was really the big deal that drove market sentiment on Wall Street overnight. But it is a massive deal, essentially. It continues to transform OpenAI in particular to really an industry behemoth. It's been inking several deals of this sort of shape, but it's all about this access to compute power. And so what's going to happen here is that AWS, or the Amazon Cloud unit, is going to be supplying a slice of OpenAI's seemingly bottomless demand for compute power. So the ChatGPT maker, that's OpenAI, of course, is going to be paying AWS for access to hundreds of thousands of Nvidia GPUs. This is part of a deal that's going to be transacted over 7 years. For Amazon, it's a very significant move because this is a company that's really sort of struggled to keep pace in the AI age, but it is an endorsement of their ability to be able to build and also to run enormous networks of data. What our Bloomberg intelligence team says is that this is all pretty much about inference capacity. They actually make the point that this deal, and we should mention it's worth $38 billion or near $40 billion, it is still, though, about 6 to 8 times smaller than the deals that OpenAI has signed with Microsoft and also with Oracle. But the Bloomberg intelligence team says that they think what actually OpenAI is looking for is leverage here, and also to diversify their cloud infrastructure as well. So they're looking at sort of how can they get advantages against other inference models or LLMs like Anthropic and also Google's Gemini.
Bell also on deals, Microsoft signing an accord with a Sydney-based data center firm.
Yeah, that's right. So this is IREN. It's actually US listed, but it is an Australian-based company. And so Microsoft signed this deal overnight. It's not quite as big as the scope of the one that we got with AWS and also OpenAI, but this one is worth nearly $10 billion. It's going to be carried out over 5 years. And Microsoft essentially is going to be, again, gaining more compute capacity from IREN here. IREN is one of the biggest data center firms, or a large one in Australia. Microsoft will now become the top customer in that company as well. So Microsoft's going to get access to Nvidia GPUs or systems in Texas. They're also putting up a 20% prepayment for this as well. So you saw that reaction in IREN. You can see that pop there, 11.5% overnight. What IREN's going to be using this cash for is to buy more advanced chips, also equipment that's going to come from Dell. And they're also thinking as well this deal could be worth around $2 billion in annualized revenue.
Belle, thanks so much for bringing us the latest on that. Some other top tech stories we're tracking as well. Palantir shares reversed gains in extended trade after the company raised its annual revenue outlook to $4.4 billion. The firm's third quarter sales outpaced analyst estimates with growth for its AI and data analytics products it describes as otherworldly. While analysts are broadly positive on the report, they note a concern over valuations, with shares up more than 170% this year. Bloomberg has learned that Alphabet is selling more than $17 billion worth of bonds in the U.S. as it invests aggressively in AI. A source says the bonds will be sold in 8 parts with maturities ranging from 3 to 50 years. Alphabet earlier issued nearly $8 billion worth of notes in Europe, marking the second largest bond sale this year in the region by a non-financial company. Now, we're also getting more details on the Trump administration's dealings ahead of the meeting with the Chinese president last week. According to the Wall Street Journal, U.S. officials advised President Trump against approving the sale of Blackwell chips to China in recent trade talks with the U.S. president. Let's bring in our China correspondent, Mimi Lo. Mimi, what do we know about the thinking of the U.S. administration here?
Yes, this is according to Wall Street Journal's reporting, and we understand that President Trump was apparently quite open to discussing the sale of these Blackwell chips to China. But then, after the Asia trip, some of his closest advisors, including Marco Rubio, but also the Trade Representative Jamieson Greer, Howard Lutnick, the Commerce Secretary as well, were all advising President Trump against approving such a sale, which is seen as a major concession from the U.S., a major loss for U.S. national security, even though you have Jensen Huang repeatedly lobbying the U.S. government to reverse that move, saying that it's a mistake to cede the entire market to China. There is also this argument that there is some advantage to letting Chinese companies be reliant on an important piece of U.S. hardware. And so right now, Wall Street Journal reporting that we know President Trump was quite open to that idea. He has previously been open to letting Nvidia sell the H20 chips to China for a cut of the revenue, and it seems like Trump is still potentially open to discussing a scaled-back version of the Blackwell chips, perhaps something that is 30 to 50% less powerful than what it is now. So potentially those talks could still happen between Trump and Nvidia, and potentially could lead to fresh talks with China to discuss the further loosening of those tech curbs in exchange for potentially more loosening of, say, rare earth restrictions from China as well.
Yeah, we always knew that when it came to semiconductors and rare earths, those conversations would be a difficult one. But there were low-hanging fruits, especially when it comes to soybean purchases. What's the latest?
Yes, soybean purchases. Last week, we already heard the shipments of 2 cargoes of soybeans that were made just ahead of the trade talks as a gesture of goodwill to the U.S. And now we are hearing from sources that a major grains importer in China is starting to inquire about shipments of wheat from the U.S. as well. Now, we are in a space where we don't really have clear data because of the U.S. government shutdown. So there is no data on shipping, on how much of these agricultural goods is actually heading towards China. But we know, for example, year to date, since October of last year, China hasn't really been buying wheat from the U.S. But year to date so far, until September this year, China's total wheat import has fallen to less than a third of what it was a year ago on the back of sluggish domestic demand and ample supply at home as well. So the big question is, even as China loosens this informal ban on importing agricultural goods from the U.S., still the big question is how much can they actually absorb in terms of supply from the U.S. and how much would it lift prices. Already we are seeing wheat futures up by the highest in about 3 months on the back of the speculation, and of course we'll be keeping an eye on exactly how many shipments we'll be getting in the coming months.
Bloomberg's China correspondent Min Lo there with the latest on that U.S.-China trade deal. As we continue to see Washington also trying to boost its supply chains related to critical minerals, the U.S. Commerce Department will provide $50 million in CHIPS Act funding to Vulcan Elements, a domestic rare earth magnet producer. The firm is also receiving a $620 million Pentagon loan and $550 million in private capital to build a U.S. magnet facility. Its partner ReElement will also get Pentagon support. The move aims to boost U.S. magnet production amid trade tensions with China. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how European futures are trading early in the Asian session. We had seen the euro under pressure as the dollar continues to extend gains, and we're seeing it at that 115 level. And European futures under pressure as well. This after we saw European stocks gain ground in the previous session. Travel had led those gains after positive comments coming from the Ryanair CEO. We're also following those chip-related stocks after China announced that they would ease their chip export ban. So we actually had car makers in Europe gaining ground, although miners were under pressure in Europe as well. Remember, we had PMI data out of China showing more economic weakness for the second largest global economy. We have more ahead on the Asia trade. This is Bloomberg.
Let's take a look at how Australia assets are faring, of course, just a couple of days after the Federal Reserve held rates unchanged for a second straight meeting. We have the RBA consensus for the decision today is for it to hold. This would be for the second straight meeting. And really, it's against the backdrop of hot inflation numbers coming in last week. The housing component, even data over the weekend, showed us that things aren't quite cooling there. So there's a lot of repricing underway in the RBA bets, perhaps pushing things out to next year for the next cutting from the Australian Central Bank. That spurred a jump in Australian yields. In the past week, we also have the banks in focus amid earnings season. We have the likes of Bloomberg Intelligence saying that the banks still could face a big profit miss, even if the RBA holds today. They see 3 more cuts in this cycle. Now, our next guest is the sole outlier among 34 economists we've surveyed, 33 of whom see the RBA holding rates today. That's after core inflation readings surged in the third quarter. Joining us now is Micaela Fuchila. She is chief economist at Jarden, who maintains a base case for a rate cut today. So, Micaela, you have a non-consensus view. Quite lonely out there among the sea of those who expect for a hold. Talk to us about the thinking behind this.
Yeah, I was actually surprised that I'm the only person expecting some easing at this meeting. I understand the CPI print, as you said, was on the stronger side, but those factors that drove it stronger weren't really related to demand increasing. It was more one-off factors. So at face value, what we have is inflation at the underlying level is at 3%, and we also have an unemployment rate that's starting to look a little bit higher than what the RBA was expecting. So even if they hold today, and my call is not the correct one, I do think there's value in thinking about the balance of risks between the two. So the RBA at this point of the cycle, they should be thinking about what weights more, if this temporary increase in inflation or the unemployment rate starting to look a little bit higher than perhaps what they were expecting before. So I would expect a very divided decision today.
Micaela, even if it doesn't move today, do you think it might move in December? Because we don't really have a consensus even going out to next year. I think we have some who see a cut in February, others who think May is more likely.
Yeah, so in our profile, we also have another cut in February and then rates on hold thereafter. So the way I think about it is that there is some value in waiting for the December meeting as well, because they will have new data on inflation. Remember, we have the new monthly inflation data coming through in November, and they will also have another print on the labour market to get a more clear picture of where the economy is at. So there is the expectations that they could just delay the cuts later. What I kind of think is perhaps my highest conviction is that the easing cycle is not yet over, that we will probably see the RBA continuing to ease a couple more times until we see rates around the neutral level.
Why aren't you giving more weight to the third quarter inflation numbers, given how broad-based they were, especially when it comes to the core key components? We know that about 50% of the inflation components rose by more than 3%. You would think that's substantial to change the game for the RBA.
Yeah, look, the components of inflation, I didn't see it as broad-based. I thought there were a few things that will ease into the next print. So, for instance, the rebates, the treatment of the rebates that we knew was going to happen, the increase of council rates, there's an annual increase that we see in every September quarter. We also saw a seasonal increase in travel for international related to peak season in Europe and also school holidays domestically. We also saw petrol prices coming back up. All of these that drove that increase are really not related to a strong, or at least they're not telling me there's a strong increase in demand that's driving prices higher. The rents were actually easier, and there was just a small increase in housing, the housing component. But it was really unclear to me that the momentum in inflation is increasing materially enough for the RBA to shift stance at this point in the cycle.
And you're not seeing that momentum in the demand side of things either. Tell us a little bit about your growth expectations and perhaps the productivity issue in Australia.
Yeah, so interestingly enough, we had household spending data for the quarter of September as well coming out yesterday. And what we saw is in real terms, the consumer actually was quite weak, so 0.2 for the quarter. That would feed into GDP, the GDP accounts coming up. And it shows that, the 50% of the outcome on GDP is the consumer, and the consumer spending is still not there, even though the fundamentals for the consumers are quite strong and the balance sheets are in good shape. So that doesn't tell me that growth is going to go above trend in the next 12 months. So in our expectations, we have growth hovering around the 2% when we think the economy could easily grow at 3.5, considering where the fundamentals are at. So we don't think the momentum in inflation will be sustained, and we think the economy is transitioning out of public sector-driven growth to a modest rise in private. So the offset of those two means growth is perhaps going to be on the flatter side in our view.
Micaela, I just wonder if I could get your thoughts on the housing component. Prices still looking hot there. But I guess to the RBA's argument about how they need to let these prices rise so that, on the construction side of things, that helps to supply the market and then bring things down again. What do you make of the RBA's suggestion of a solution?
Yeah, so I don't think the RBA's got a solution for the housing supply issue. It's more a government. The government's doing a lot to address that lack of supply, and that's also supporting home prices going up as well, which is also nothing to do with the RBA's policy. Rates have come off, and we have seen a response in the housing sector, particularly on the prices side, but we haven't seen activity picking up just yet. Only yesterday we saw some pickup in building approvals in some regions, particularly for apartments in response to those policies from the government. But we're not really seeing construction employment picking up or all of those sensitive sectors to interest rates picking up yet. So it's very unclear to me that at this point in the cycle we're seeing a demand-driven cycle from the interest rate easing that we saw early in this year.
Just quickly before we let you go, I guess you alluded to some of this earlier. Do you think the goal for the RBA is still inflation towards 2.5%?
Yeah, so this is another thing, right? The RBA, just like the US Fed, they have a dual mandate. They have to try to strike a balance between keeping inflation at target and also having maximizing or keeping these labor market gains for as long as possible. Remember, before this cycle, the unemployment was very high at around 5%, and it was kind of hard to get it down. So the RBA will have these two in mind. And this is why I think having only 6% priced in for a cut today is a bit unusual, considering that we are seeing unemployment rising at the same time that we're seeing inflation moving sideways. And this is not the only region where we're seeing that as well. We're seeing it in the UK, we're seeing it in the US as well. So it seems more like a global thing where central banks are trying to decide to support growth and employment over inflation. So I think obviously the focus, considering how strong the outcomes on CPI were in this release, they will be focusing on inflation, but also they won't completely ignore the fact that the employment growth is looking a little bit softer than it did last year.
Micaela, Fuchila, good to have you with us, Chief Economist at Jarden, as we await the RBA rate decision today. We have more in Australia ahead every Tuesday at 11:40 a.m. if you're watching in Sydney, 8:40 a.m. in Hong Kong. And you can tune in to the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. Find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.
Keep an open mind. This really means assessing the incoming information, keep an open mind, and make the decision that balances those risks and ensures that the economy can go on and achieve the soft landing.
I think that the Fed is too restrictive. I think that neutral is quite a ways below where current policy is. And given my rather more sanguine outlook on inflation than some of the other members of the committee, I don't see a reason for keeping policy as restrictive for a long period of time as we are. The longer you keep policy restrictive, the more you run the risk that monetary policy itself causes a downturn in the economy.
Fed speakers there. Of course, this comes off a week where the comments from Fed Chair Jay Powell really caused the markets to think twice about December being a foregone conclusion in terms of a rate cut. And since we're hearing from more Fed officials, including the likes of Austin Goolsbee, saying that he seems a bit more worried about inflation than the jobs market. Of course, on the, I guess, more dovish side of things, you have Stephen Myron and also the likes of Mary Daly. Even Lisa Cook suggested that, maybe a rate cut can be supported come December. But as we've been hearing from Fed officials, they're saying, look at the data, but there are, of course, gaps amid the U.S. government shutdown. Where do we have, or where can we actually get some of the data? Worth noting that when it comes to the U.S. 10-year yields are at 4.10 thereabouts. It has been quite a turnaround, all things being considered, on treasuries. Consider the Sell America theme from earlier in the year. Shery?
Yeah, I mean, that Sell America theme really sending treasuries up about 6% this year already. So really, investors still looking at the least worst option when it comes to the fact that the other major central banks are either close to ending the rate cutting cycle or possibly raising rates. Take a look at how currencies are trading on the other side of the U.S. dollar trade, because the dollar has been extending gains in the last few days, and we're seeing the Japanese yen past that 154 level per dollar. We are talking about a February low. We had seen some officials across Japan trying to boost up the Japanese currency, but we're still weakening against the greenback. Let's turn to one company, Animoca Brands, planning to go public on the Nasdaq Stock Exchange through a reverse merger. This deal would mark Animoca's return to public markets after being delisted from the ASX in 2020 due to concerns over breaches of listing rules. To tell us more about these plans, we're joined now by Yatsu, co-founder and executive chairman of Animoca Brands. Our tech correspondent, Annabelle Drewlers, is also with us for this conversation. Yatsu, really good to have you with us, and congratulations on this merger. But we know that approvals are still pending in the U.S. and also in Australia. So when do you expect these to come through, and what are you getting done in order to meet these regulatory standards?
So I think, generally speaking, we think it's going to take about a year for closing. And I think what's happening right now is that, right now it is a non-binding LOI. So we basically have an exclusivity in where we're going to sort of hammer out essentially all the definitives. And then from that path forward, basically we will march towards basically getting all the approvals in Australia, of course, in America. There's closing conditions as well. So all of this will be ironed out. But I mean, I think the messaging here is clear. Animoca intends to return into the capital markets in the U.S. at the starting point, on the Nasdaq, with a very strategic target as well.
Yeah, why the Nasdaq? And I also mentioned how it was delisted in 2020 from the ASX, right? So what are some of the lessons that you've taken from here?
Well, I think the real thing to think about is sort of, 2020 and really it was 2019 where actually I would say some of the troubles began, is actually mostly related to the fact that we were dealing in crypto, right? And I think back then, if you remember 2019, 2020, crypto was somewhat of, a less sort of accepted sort of, I guess, asset class of sorts. And really the US has become much more friendlier towards it overall. It has very deep capital markets. We, look at the US as really a place that wants to become essentially, one of the centers of crypto, if not maybe the main place. And so it makes sense for us to sort of enter that market. And if you look at sort of the peers in the space, right, where you look at Coinbase, or you look at Circle, or you look at Bullish, or you look at, Hong Kong-based Bullish, or if you look at Gemini, all these have been incredibly successful sort of IPOs of some sort in the US. So it kind of sort of made sense for us initially from that perspective. And, of course, the regime today, crypto is much more accepted. People understand basically digital assets and virtual assets much more than before, which meant that it makes more sense for us to go and be more institutional in this sort of new environment, which before was harder because a lot of the institutions were yet to get familiar with it.
Yeah, I think part of it as well from the ASX 200 or the ASX perspective was also just the difficulty, I think maybe to your point around crypto, but the difficulty of trying to value and account for your financials. And part of this deal as well for the US hinges on you filing audited financial statements.
Absolutely.
When do you expect that to happen?
So it should happen within basically the 12 months, right? We already completed the last audit for 21. The next audit basically is due this year, and basically we're just catching up on all the audits. We've got this basically happening right now in real time, and obviously this is the must. And again, it's not a choice for us, right? Obviously we know that, but there was a lot of difficulty finding auditors who understood crypto at the time, which of course today is much more straightforward.
And also as well that option of taking a reverse merger instead of a straight IPO in the US, why did you follow that path?
Well, I mean, if you look at companies, for instance, like sort of DraftKings or SoFi, although I think that was a SPAC, but it's kind of similar in nature, right? There's been very successful examples around that, but also I think the company currency here is actually a company that is adjacent to the space, right? So this is a company that's basically in the fintech space, deals with payments. actually has a sort of, I guess, somewhat crypto adjacent business as well. So there's some strategic angle around that. And then the other one, of course, is for us as a business, we're very much sort of focused as essentially the sort of, I guess, altcoin index company, if you will, right? People are focusing on sort of, Bitcoin and Ethereum and Solana, but really 25% of the market is essentially the other tokens, which is basically altcoins. And that's basically what Animoca represents. And so speed to market does matter here, we think, right? There is, I think, a premium for being, first to market. And so I think that's one of the reasons we chose this path as well. So we can basically sort of accelerate this entry point. And if you look at digital asset treasuries as well, I mean, they're typically sort of choosing this path, and it's been quite successful for many of them. So we think this is appropriate.
You've actually called yourself a levered bet on altcoins at a time when we're actually seeing these altcoins underperform even Bitcoin, and at a time when we're seeing also equities become very, very attractive to investors. So where do you see this whole space going, especially on price levels that have to compete with, say, the AI frenzy that's sending stock markets to a whole different game?
Well, I mean, first of all, I think it's a buying opportunity from our perspective, but more importantly, Animoca is a bit different because we have essentially the lowest entry price on altcoins. I mean, it's not just because we're incubating or investing in early stages, but we're also advising and supporting companies launching these altcoins. And what is an altcoin? Altcoins is actually where all the growth and activity is happening on chain with digital assets. Bitcoin is, the ultimate store of value from the crypto perspective. It's kind of like digital gold, right? But look at gold today. Gold is a $27 trillion asset. Amazing, right? Bigger than any company in the world. But if you add all listed companies in the world, roughly $128 trillion, and the private companies, which are about plus $80 trillion, you've got $200 trillion of market cap vis-a-vis gold's $27 trillion of market cap. And again, people aren't using gold per se, but they're using Apple or Google or Amazon or all these applications or these services or these media companies that are listed. And that's what altcoins represents, right? Altcoins are represented by people who are, whether it's playing games or whether it's using DeFi protocols or whether it's finance or whether it's AI protocols, they're actually all happening in the altcoin space, and user adoption is happening from that. But you're correct, altcoins are lower than Bitcoin collectively today. It's roughly only 25 to 30% of the entire sort of crypto market, which is to us the opportunity, right? And it's not that dissimilar from where gold was vis-a-vis other companies as well. So our belief is that altcoins, because of all the utility and growth, is actually going to be outperforming Bitcoin as a collective, not individually. That means, you have to have basically an altcoin basket, if you will. And I think we're one of the best companies positioned to do that.
I noticed as well that a couple of years ago you did announce that $2 billion metaverse fund that was significantly downsized. What are the chances of, that similar sort of path of having to downsize your fundraising efforts happening this time?
So right now we announced sort of the reverse merger, so we didn't actually announce a fundraising at this moment in time. If you think about what happened before, we decided just to invest out of our own balance sheet, right? And sort of, our last reporting on the balance sheet is about $1.4 billion. Basically, these are things that we basically purchased and invested ourselves and generated. So from that vantage point, it didn't really make sense to have the fund in and of itself. And also, one of the advantages now that we feel at investing out of the balance sheet is actually, it's something that you can do long term. Like if you think about certainly our lens is that the internet back in the day, right? If you were a fund, you typically have a 5 or 7 year, maybe 10-year sort of life cycle. You were forced to basically sort of liquidate your positions just for fund returns, which is understandable. But if you think about what we believe in, altcoins are representing opportunities similar to the early days of the Amazon, the Googles, the sort of eBay's, those type of companies at the time, and Apples and so on. It wouldn't have made sense from our vantage point to basically sort of sell these positions. And because they're altcoins, they're tokens, you can actually generate yield from them, right? So we're a profitable business. It's generating revenues and cash flow, right? And from that cash flow, we can continue to reinvest in the space as we accumulate essentially these future asset class. And you had mentioned earlier AI as well. Well, one of the things that a lot of people might not fully understand is that actually tokenizing and essentially crypto assets, particularly altcoins, are the AI readable asset class for essentially AI. So if you have AIs trading with each other, they're not going to do it with a bank account. They're not going to have a PayPal or something like that. They're going to be doing it basically with crypto assets because it's their native type of sort of currency or asset class. And if you as a business aren't thinking about tokenizing yourself, you're basically becoming invisible to these AI sort of agents. Which is basically, it's kind of like back in the early days, if you were not on Google or if you were not on Facebook or Instagram or on social media, you would become invisible as well. Right now, you have to think about tokenizing your business or tokenizing aspects of your business to be AI readable.
Yeah, Tia, good to have you with us. Congratulations on that reverse merger. Co-founder and executive chairman at Animoca Brands, and of course our tech correspondent Annabelle Jewelers here with this conversation as well. We have more ahead. This is Bloomberg.
We have seen the competitiveness and attractiveness of Hong Kong's financial market. We have again proved one country, two systems has strong vitality, that Hong Kong has a solid foundation for long-term prosperity and stability, and its status as an IFC will continue to be strengthened. Ladies and gentlemen, dear friends, last month, the fifth plenary session of the 20th Central Committee of the Communist Party was successfully held in Beijing. And we have seen the 15th five-year plan being reviewed and adopted. Looking back at the 14th five-year plan, we have achieved great achievements. Our economic strength, scientific and technological capabilities have achieved new heights. We have seen great progress for the modernization of China. Starting from this year, China's economy continued to make steady progress. We have demonstrated strong resilience and vitality. In the first 3 quarters, the economy grew by 5.2% year-on-year, ranking among the top of the major economies globally, and we are fully equipped.
The Chinese Vice Premier He Lifeng delivering the opening keynote address at the Global Financial Leaders Investment Summit in Hong Kong. And of course, that is a pre-recorded speech from the Chinese Vice Premier. We are watching the markets open next in China, of course, against the backdrop of the AI narrative that's fueled parts of the Asia trade. That's it from today's edition of the program. Our markets coverage continues. This is Bloomberg.